Hey everyone, welcome back to Corporate Decoder. Today, Calisa Acquisition Corp just filed an S-4 registration statement, and I am seeing a major shift in who controls the future of this company. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing shows a SPAC merge with Goodvision AI. And the numbers here reveal a pretty dramatic drop in what SPAC public shareholders might end up owning. Alright, so this is a big deal officially filed with the US Securities and Exchange Commission. It is essentially a registration statement for a SPAC merger, a company called Calisa Acquisition Corp, ticker ALISU on NASDAQ, which is planning to combine with Goodvision AI Inc. This is a crucial step before the deal can go through. The document itself is a Form S-4, which is like a prospectus combined with a proxy statement. It tells you everything you need to know about this planned merger. They're registering a bunch of ordinary shares, about 27 million of them, which will be offered when this deal closes. The goal is for Calisa Acquisition Corp to become Goodvision AI Holding Limited after the merger. Now, who is Goodvision AI Inc.? They're described as a global cloud computing and AI infrastructure solutions provider. They're into multi-cloud services, AI computing, and hybrid cloud infrastructure. They generated revenue of about $7.7 million in fiscal year 2025, with a net income of around $80,000. So while they're growing, they're still in the early stages. The story behind this deal starts back in October 2025 when Calisa Acquisition Corp, or SPAC as they're calling it here, completed its initial public offering. Since then, SPAC management has been looking for a good company to merge with. They looked at over 40 potential targets, but eventually settled on Goodvision AI. The SPAC board and their advisors considered a lot of factors, including Goodvision's growth industry, its readiness to be a public company, and its management team. But here is a key point. They also considered some potentially negative factors, like the risk of many public shareholders redeeming their shares, which could really impact the amount of cash the combined company has. To make sure the deal was on the level, SPAC got a fairness opinion from Newbridge Securities Corporation. They basically said that the merger consideration to be paid to Goodvision shareholders was fair from a financial point of view to SPAC's unaffiliated shareholders. They also said the transaction had a fair market value of at least 80% of the assets held in the trust account. It's important to remember though, this opinion is based on conditions at that specific time in March 2026, and Newbridge doesn't have to update it if things change later. Let's dive into the money and ownership here, because that is where things get really interesting. This table is crucial. It shows who owns what after the merger, depending on how many SPAC shareholders decide to cash out their shares instead of holding onto them. If nobody redeems their shares, SPAC's public shareholders end up with about 23% of the new company. In that best case scenario for SPAC shareholders, where no one redeems, they get 6.6 million shares. But look at the flip side. If maximum redemptions happen, meaning most SPAC shareholders cash out, the public shareholders who stayed in would only own about 1.4 million shares. That is a massive drop in ownership. Meanwhile, the original Goodvision shareholders are looking at keeping a much larger chunk of the pie. In the no redemption scenario, they hold 18 million shares, which is over 63%. If maximum redemptions happen, their stake jumps to nearly 78%. Clearly, the original owners of Goodvision are set to dominate the post-merger company. Even with all those redemptions, the total number of shares still hovers around 22 to 27 million. This dilutes everyone's ownership percentage as more shares are issued. And if that wasn't enough dilution, the numbers don't even include shares reserved for an equity incentive plan. That is another 1.3 million shares potentially hitting the market, adding about 4.7% dilution across all scenarios. So the real ownership percentage could be even lower for public SPAC shareholders. Now let's talk about the per share value. If no one redeems, the adjusted net tangible book value per S-share is about $6.25. But if maximum redemptions occur, that number plummets to just $1.15 per S-share. This is a huge difference and a major red flag for those who choose not to redeem. The dilution here is significant. In the no redemption scenario, it's about $3.75 per S-share. But in the maximum redemption scenario, that dilution balloons to nearly $8.85 per S-share. This means that even if the stock price stays at $10, which was the IPO price at non, redeeming shareholder could still see their investment value reduced due to dilution alone. Looking at the financing, they plan to obtain at least $5 million in additional financing. They've already got a $1 million equity investment in the bag from an accredited investor and a $1 million convertible note. This is critical because if they can't raise enough cash, their capital after the merger will be lower than expected, making it harder to stay listed on NASDAQ. Let's shift gears and look at Goodvision's financial health and strategy. They're reporting solid revenue growth, mostly from their established cloud resale business. For the 3 months ending March 2026, revenue hit $7.2 million, a massive jump from the previous year's $1.3 million. So, the core business is growing. That impressive revenue growth continued for the 6 months ending March 2026, reaching $10.6 million, up from $2.7 million in the prior year period. This is thanks to expanding their cloud customer base and, importantly, launching their AI inference services in March 2026. But here is the catch: while revenue is booming, gross profit is much smaller. For that same 3-month period, gross profit was only about $335,000, a 4.6% gross margin. For the 6 months, it was $564,000, a 5.3% margin. This is because their cost of revenue, mostly fees to cloud providers like Tencent Cloud and LLM providers, is very high. And to top it off, general and administrative expenses are through the roof. For the 3 months ending March 2026, they spent over $500,000 on GTR, a huge jump from practically nothing the prior year. This is driven by legal and accounting fees related to this merger and getting ready to be a public company. It is clear these merger-related costs are a big drag on their current profitability. Now, let's talk risks. The filing flags quite a few. For SPAC itself, the big ones are that the sponsors and directors have different interests than public shareholders, meaning they might push for a deal even if it is not ideal. There is also dilution, the risk of losing your investment if the deal fails, and potential delisting from NASDAQ if they can't meet requirements. For Goodvision, the company they're merging with, the risks are more operational. They heavily rely on third-party cloud providers, and any disruption there could hurt them. Their AI scheduling platform is still new and might not catch on. Plus, there are cybersecurity risks, potential data breaches, and the challenge of attracting and retaining top AI talent. This is a huge one. After the merger, surviving Pubco will have a dual class share structure. Class B shares get 40 votes per share, while Class A only get 1. This means the founder, Yi Wang, will have massive voting control, around 77 to 82% depending on redemptions. This concentration of power might not be good for minority shareholders. Goodvision's reliance on providers like Tencent Cloud is a big deal. They account for a huge chunk of their costs. If these providers hike prices or cut off services, Goodvision's margins will take a hit, and frankly, they might not be able to pass those costs on to their customers. Let's look at the pro forma financials, which try to show what the combined company would look like. As of the 31st of March 2026, if there were no redemptions, the balance sheet shows total assets of about $65 million. But if maximum redemptions happen, that number plummets to just $12.5 million. That is a huge difference in the company's cash position post-merger. And looking at profitability for the 6 months ending March 2026, the pro forma net loss is a hefty $5.1 million. The loss per S-share, even in the best case, no redemption scenario, is about 19 cents. If maximum redemptions occur, that loss per share jumps to almost 24 cents. This shows the financial strain from the merger and potential redemptions. Goodvision's vision is pretty ambitious. AI inference that is abundant, low latency and affordable everywhere, cloud, edge, and device without being locked into one vendor. Their mission is to orchestrate the right models and compute to make every inference faster, cheaper, and easier to ship. Their core future product is this AI intelligent scheduling platform, their inference compute brain. It is designed to route AI tasks to the best model and compute resource, whether it is in the cloud or on the edge. It is still in development with limited previews launched. They're aiming for broader release by June 2026. But there are no guarantees. They'll need about $500,000 more for development, funded by operating cash flow and anticipated financing. They also plan to build out AI factories for edge inference, basically mini data centers closer to users. This is a capital-intensive strategy requiring tens of millions of dollars, with Goodvision contributing a small portion and seeking partners for the rest. They're targeting deployment by September 2026. But again, no guarantees. Historically, Goodvision served a limited number of large customers, with 2 accounting for nearly all revenue in former years. While it is diversified somewhat, concentration remains a risk. For the 3 months ending March 2026, 3 customers made up about 90% of revenue. Now, back to Calisa Acquisition Corp. They are a SPAC, a shell company formed specifically to merge with another company. They operate on a blank check plan, looking for a target business. They completed their IPO in October 2025, raising $60 million with about $60 million in trust for this deal. The SPAC board's reasons for recommending this deal heavily lean on Goodvision operating in a growing industry, having a public company ready structure, an experienced management team, and a fair valuation. However, they acknowledge the inherent risks like potentially not achieving the expected benefits and the high level of shareholder redemptions. This is where we see the big impact for SPAC shareholders. In the no redemption scenario, SPAC's original public shareholders end up with about 24% of the new company. But if maximum redemptions occur, that shrinks to around 6%. This is a massive dilution of ownership for those who don't redeem. So what is the story here? It looks like a classic SPAC deal, where the original SPAC shareholders are likely to be heavily diluted, and the founders of Goodvision will retain a dominant stake and voting control. Goodvision has promising revenue growth from its cloud services, but the big bet is on its developing AI platform. The financial projections are optimistic, but carry a lot of risk given the early stage of these new services and the capital-intensive nature of AI infrastructure. The dual-class share structure also means minority shareholders will have very little say in the company's direction. Overall, it looks like a high-risk, high-reward situation, with the scales heavily tipped towards the existing Goodvision shareholders benefiting most if things go well. The research tools I use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, and subscribe, and check out the Discord linked in the description.